In this lecture, we will go over the CFA Level 2 reading on employee compensation. There are two major sections in this reading. This is the big one, and this section deals with pensions and other post-employment benefits. And then there is a small segment on share-based compensation. Many people refer to this reading as pension accounting because a significant chunk of this reading has to do with how to account for pensions and other post-employment benefits. Section 2, which is the big one, has these four subsections. We will talk about the different types of post-employment benefits, then how to measure a defined pension plan's liabilities. Section 2.3 covers measuring a defined pension plan's periodic costs. This is very testable. And then reporting of pension and other post-employment benefits. You need to understand how this information is reported and what are the sorts of adjustments that you might need to make when you are comparing different companies. What are the different types of post-retirement benefits? The most basic category is a defined contribution pension plan, and these are becoming increasingly popular. In a defined contribution or DC pension plan, specific or agreed upon contributions are made to an employee's pension plan. So you have the employer who makes an agreement with the employee that every period this much money or this much funds will be transferred. That money is invested. Normally the company also provides different investment schemes where the money can be put, and then the future value of the benefits, how much that money appreciates or if it doesn't appreciate, that depends on how the investments perform. The big point with defined contribution plans is that the employee bears the investment risk. The accounting is also fairly straightforward because in every period the amount contributed is shown as an expense for that period. Then we come to defined benefit pension plans. So this is going to be the big one in terms of testability. This is the big one in terms of where the world is headed, but this is not overly testable. It's just a few basic points. Here there is a lot to talk about. In defined benefit plans, the pension benefit and not the amount is defined, and generally depends on factors like years of service and compensation level. And we'll see this in a lot of detail. Critical point again is that the benefit is defined. Future pension payments represent a liability for the employer and need to be estimated. So if an employer is saying, look, when you retire, I will give you this much pension, obviously that then is an obligation, a liability for the employer. Since the employer is committing a level of benefit, the employer bears the investment risk. The cost of that benefit might be high, it might be low. As far as the employee is concerned, the employee is going to get that benefit. So the risk or the obligation is with the employer. Plans are typically pre-funded, and you will hear this term plan assets that we'll talk about in more detail. But clearly what a company will not want is after 20 years when it needs to make payments, then find out, okay, we don't have the money. So companies create what is called plan assets so that money is available to meet the liability in the future. And then there is this other category, other post-employment benefits, generally referred to as OPB. These are promises by the company to pay benefits in the future, such as life insurance, healthcare insurance, and so on. OPB, or other post-employment benefits, are typically classified as defined benefit plans because here again the benefit is defined and the accounting is very similar to DB plans. So you will often see these two being referred to together. Here again, the employer bears the investment risk. Generally, other post-employment benefit plans are not pre-funded, but the regulations can vary from country to country. Even here, with defined benefit plans, different countries will have different regulations about how much a company needs to fund these obligations. Measuring a defined benefit plan's obligation. So how does a company figure out how much it actually owes? What's the value of the liability? What's the value of the obligation? Under IFRS, there is this concept called present value of defined benefit obligation, or PVDBO. The idea being that the benefit is defined, the obligation is defined, and then we try to quantify that obligation and find the present value of that obligation. US GAAP has a similar concept, but it's called projected benefit obligation, or PBO. This particular reading collectively refers to these two as the pension obligation. So in the reading, whenever you see pension obligation, they are actually referring to the present value of the future obligation. As you might imagine, a company needs to make several assumptions to calculate pension obligations. And I'll just touch on some of them over here, and then we'll see this in more detail later. But if a company says that it will pay a pension based on the final salary multiplied by some percentage, then clearly assumptions need to be made about what the salaries will be in the future. In other words, what is the rate at which salaries are increasing. And then if we are calculating a present value, then clearly there needs to be an assumption about discount rates. And then there also need to be assumptions about expected vesting. Vesting means that an employee needs to work for a certain period in order to earn the right to the benefit. So we need to make assumptions about vesting periods. Financial statement reporting of pension plans and other post-employment benefits. How do we report defined contribution pension plans? I alluded to this earlier. This is fairly straightforward. Every period, the company shows an expense. So if a company is making contributions of 2 million to its employees' accounts, that is the expense. Occasionally, if the cash flow or the cash hasn't been paid, then there is a short-term liability created, which is then backed out once the actual payment is made. But the accounting is very straightforward. You can think of this effectively like salary. Here is the slightly more complicated one, defined benefit pension plans. Both IFRS and US GAAP require the funded status to be reported on the balance sheet. So this term, funded status, is extremely important. The funded status is equal to the present value of the defined benefit obligation, or the pension obligation, minus the fair value of plan assets. I've touched on this before, but I'll just explain again what exactly this means. So you have a company here at time 0. Let's say that at time t in the future, it expects that it needs to make a certain amount of pension related payments. So to meet this obligation, a company creates a plan assets portfolio over here. So when we say plan over here, this is referring to the pension plan. So to fund this liability or this obligation in the future, asset or a portfolio is created over here. I'm also going to connect this discussion a little bit with the ethics that you've seen before. Generally, these pension plans are given to another company or another organization to manage, but the ownership obviously is with the sponsoring company. Also, the beneficiaries of this plan asset needs to be the employees of the company. So if you are a portfolio manager running this account, your beneficiary or your client in one sense is the employee of the organization, though you report to the sponsor or the organization. Now I'm going to skip those details over here. We will just assume for simplicity that this plan assets account belongs to the company or the sponsor. Now this asset or this portfolio hopefully will grow at a certain rate so that eventually it will be big enough to meet the obligation. If we are talking about reporting our obligation at time 0, then what is the net obligation? The net obligation means you take your obligation in the future, find the present value at time 0. So that's the present value of the obligation. We are calling this DBO over here, or this simply might be the pension obligation. And then the plan assets have a certain value over here. we take the fair value of the plan assets, that's this number over here, and then the difference represents the funded status. If the present value of your obligation is 120 and the fair value of the plan assets is 100, then you say that your funded status is 20. And if you think about the convention being used over here, we are saying that the funded status is a liability, right? So this 20 is a liability of 20, and the reason it is done this way is generally the funded status is shown as a liability. Generally, the present value of obligations tends to be more than the assets. Now, that's not always the case. It might be that the funded status is a net asset, in which case a net asset will be shown on the balance sheet. In some textbooks, you might see this the other way around, but you need to look at the context and be aware. Also, when you look at the exam question, make sure you understand the convention. It will be clear from the context whether a positive number is referring to this being an asset or a liability. So be careful. It's slightly tricky. Just as a side remark, if you hear the term a plan is underfunded, that means that it's a net liability. The present value of the DBO is more than the fair value of plan assets. And again, I'll emphasize, even in the curriculum, there are places where sometimes we look at this expression, sometimes the curriculum has done fair value of assets minus liability. So from the context, you need to figure out what's going on. On the balance sheet, on the face of the balance sheet, only one number will be reported, either as a net asset or as a net liability. I would say that if you do get a question on this subject, then there is a very high probability that one of the questions will involve coming up with this particular number. Just note one caveat here. The amount of reported assets is subject to a ceiling defined as the present value of future economic benefits. And what do we mean by future economic benefits? These could include any refunds from the plan or reductions in future contributions. So what does this mean? And the next example will actually illustrate this very clearly. If your liability is more than the asset, then clearly you have a net liability and that's reported. It is a simple subtraction. But what if the plan asset is greater than the liability? Then your first calculation is to say, okay, the net asset is equal to the plan asset minus the plan liability or the defined benefit obligation. You take that number, which is the net asset, and then you compare that number with the present value of the future economic benefit. And then you take whichever number is lower. Let's do this through an example. First, we take a simple scenario, and I want you to do this. The working for ABC is fairly straightforward. We have this liability, this asset, and then on the balance sheet, we will show a net liability of 1843. This plan is underfunded. Now I want you to do DEF, which is slightly more complicated. With DEF, you notice that this plan is overfunded because the obligation is 5485. The fair value of the plan asset is higher. This difference is 513. But as discussed on the previous slide, you don't just take this without doing any further calculation. You need to actually compare this with the present value of future benefits. That number is 326. And then we do the conservative thing and take the lower number. So in this case, we say that the net plan asset or the net status is a net asset of 326. This plan is overfunded. So you might be wondering exactly what the 326 means. First of all, memorize a simple point. It's the present value of any future benefit. Now, what does that mean? If a plan is overfunded, then what are the sorts of future benefits they can be for the company? One is, if you are already overfunded, then there might be some refunds because obligations will not be paid. As in, the obligations will be covered and there'll be money left, so you are expecting some refunds. That's one aspect. another aspect which you will understand in more detail as we get further into this lecture, but you can expect some expenses in the future. But because the pension fund is overfunded, the amount of contributions you will need to make will be less than the projected expense. Very roughly speaking, this is like a prepaid asset. So the point being that if you anticipate benefits in the future because you are overfunded, you take those benefits and come up with the present value of those benefits. That's all there is to it. Actually, I should rephrase. That's all there is to it as far as what you need to know. If you want to become an expert at this stuff, I'm sure there is more level of detail. But from an exam perspective, that's good enough. This is the explanation in the curriculum. All right. Next, we come to the periodic pension costs. So we've talked about the balance sheet. What do we show on the balance sheet? Now we look at the income statement, and then we'll also look at OCI. We are talking about the pension cost, what to show in every period. Earlier point was what to show at a given date on the balance sheet. Now, what do we show over a given period? The periodic cost of a company's DB pension plan is the change in the net pension liability or asset adjusted for the employer's contributions. Each period, the pension cost is recognized in the profit or loss and or in other comprehensive income. I'm going to touch on this briefly now, and then there'll be more discussion on this later. But simplistically, the idea is this. Let's say that at the start of a period, the pension liability or the net obligation is 100. And then at the end of the period, the obligation goes up to 150. And there are no contributions made by the employer to the plan asset. So if the value of the liability is going up, then what is the cost over the period? It is simply the change in the net obligation or change in the net liability. So the cost is 50. And what this explanation is saying is that this 50 is allocated between the P&L and the OCI. How this allocation happens is something that we will see later. One point. The other point is that if you are told that during this period, a contribution is made to the plan of 50, I'm just giving you a number. So during this period, the contribution is equal to 50, and the value went from 100 to 110. Then what is the pension cost during this period? Do you just do 110 minus 100 and say that it is 10, or do you reflect this also? So what you do is you go from 100 to 110 and you add the contribution, that's the adjustment. So your expense, or actually I should say the cost is 60, right? There'll be more on this later. For now, at least just recognize this simple scenario. The other point that you need to recognize here is that the pension cost or the periodic cost has multiple components, and you need to know those components. This also is very testable. Here I'm showing you the IFRS components as defined in the curriculum, and then later we'll also look at US GAAP components. These are the three components. The first and major one is the service cost. This is recognized in the P&L. The service cost means that during a given period, your employee is working and earning some benefits. The benefits earned during that period are the service costs. Now that benefit might be because of the current period and also because of prior periods. The combination is called service costs, and again there'll be more on this later. Just for now, understand the fact that a major component is service costs. Then you can also have what's called the net income or expense. This is recognized in the P&L as the following amount: the net pension liability or asset multiplied by the interest rate. This is actually the net interest income or expense. If there is a liability at the start of any period, What is the interest expense for that period? It is a certain rate, which is the discount rate, multiplied by the liability at the start of a period. So that is the interest expense component. And then the third component is remeasurements. This is the net return on plan assets and actuarial gains and losses. These are two subcomponents of remeasurements. These numbers are recognized in OCI and then they stay in other comprehensive income. They are not moved to the P&L. The net return on plan assets is equal to the actual return. What does this mean? During a given period, there will be an actual return on plan assets. You might have plan assets that were worth 100 at the start of the period and actually went up to 110. This actual return of 10% is called the actual return, minus plan assets into an interest rate. The interest rate in this context is the discount rate. Remember, when we come up with a present value, you take the future obligation and then discount back at a certain rate. That is the discount rate, and in IFRS that is also simply called the interest rate. Notice that when we come up with the interest expense over here, based on this, what are we doing? Are we just looking at the liability or are we looking at the net liability? We are looking at the net liability, which is the present value of the obligation minus the plan assets. So we are taking both. We are also taking the effect there of the plan assets. And what is the rate we are using with the plan assets? The rate that we are using is the discount rate. But does the discount rate represent your actual return on the asset? It does not. So effectively what we are doing here in OCI is backing out. The minus means that we are backing out that estimate, which was the plan asset times the interest rate. So this is being backed out of this. And then the actual return on the plan asset is being shown over here as part of other comprehensive income. And then, unless US GAAP, which we'll talk about later, this amount stays in OCI. It never moves to the P&L. The other subcategory is actuarial gains and losses. Changes in a company's pension obligation arising from changes in actuarial assumptions. We'll see actuarial assumptions later, but the point is you make assumptions about the rate at which salaries will increase. You make assumptions about how long people will live for after retiring and so on. If you make a change in those assumptions, does that change the value of the benefit? It does. Does that change the present value? Obviously it does. Those changes also need to be shown somewhere. And those changes are called actuarial gains and losses. In terms of reporting, they are shown in, even this is shown in OCI and not in the regular income statement. Some students get confused about the relationship between this item and this item. So I'll give a very simple example. Let's say we have a plan which is 100% funded, which means that at the start of a given period, the plan assets is equal to the present value of the liability. So let's say plan assets equal 100 and the pension obligation is also 100. So our net value is 0. Let's also say that our interest rate is equal to 5%. Then what is this number, the net interest income or expense? It's the net pension liability or asset, which in our scenario is 0, multiplied by an interest rate of 5%, which is 0. Obviously, if your net liability is more, then you'll have a expense. If you have a net asset, then you will have a income over here. Now, during this period, let's say that the plan assets actually went up by 10%. This is the actual scenario. How do we reflect the fact that the plan assets actually went up by 10% versus this estimated number of 5%? What you do is take the actual return, which in our scenario is 10, minus plan assets into the interest rate. The plan assets were 100 at the start of the period, multiplied by the interest rate, which was 5%. This will give you 10 minus 5, which is 5, and this 5 is one component of remeasurements, and that goes into OCI. Hopefully that makes it relatively clear. What is the effect of assumptions and actuarial gains and losses on pension and other post-employment benefit costs? This is a high-level slide. The pension obligation and pension expense is based on several assumptions. Assumptions about turnover, assumptions about the level of service, the rate of increase of compensation levels, what is the life expectancy, what is the discount rate or the interest rate at which we discount, what is the expected return on plan assets. This is a US GAAP concept. An increase in pension obligation resulting from a change in any of these assumptions, resulting from changes in actuarial assumptions, that's assumptions about these items, is considered an actuarial loss. And remember the basic point from level 1, when a liability increases, that is an expense or a loss. If the liability decreases, then that's considered an actuarial gain. In other words, just memorize the fact that in our context, actuarial has to do with assumptions. It's the assumptions that actuaries make, and that obviously drives the value of a liability. Now, what I'm going to do with you is a very simple example that I came up with, and this example will set you up to understand the slightly more complicated example in the curriculum. It will also help you understand two of the most important components of the pension cost, which are the service cost and the interest cost. Let's say that you want to estimate the pension obligation at various points in time, and the service cost and the interest cost, these are period costs, and we are going to do this over a 3-year period, and we'll make some very basic assumptions. We have one employee with a current annual salary of 100, and this salary will remain unchanged. So if we are considering a 3-year period, 0, 1, 2, 3, we are expecting that this employee will stay with us for 3 years. Every year the salary is 100. At the end of 3 years, we are going to make a pension payment. And what is that payment? It's a lump sum pension payment, and will be made based on a formula. Generally, pension plans are based on a formula. What is our simple formula? Our simple formula is that the pension payment is one payment equal to the number of years worked, which for us is 3, multiplied by the final annual salary, which is 100, and then multiplied by 25% or 0.25. All right. So what we are saying is that this number, 300 into 0.25, which is 75, this is the payment at the end. So what is the present value? The discount rate is 10%. What is the present value of the obligation? What you might jump to is that the present value of the obligation is this number divided by 1.1 cubed, but that would not be true. Why? Because a pension benefit is earned. If somebody has not worked much, or let's say the employee is starting over here, or the pension plan is starting over here based on service from now on, has anything been earned? It has not been earned. The way most pension plans work is periods are defined, and once you have served for that period, then you start earning a benefit. So we have 3 units or 3 periods. Once you are done with the first period, and this can also be thought of as a vesting period, at the end you have finally earned some of this. So how much do you earn in every period? In every period you earn 25. This is your benefit of 75. So for every period you earn 25, and this is going to lead us to the concept of the service cost. Notice that the service provided by the employee in the first period is contributing to this number. So we have established that the pension obligation at time 0 is equal to 0. what is the interest expense at time 0? The interest expense is the liability, which is 0 times a rate of 10, so anything times 0 is 0. So the interest expense for the first period is 0. What about the service expense or the service cost for this whole period? Okay, now you need to be careful here. When we report the pension obligation or we report the service cost, here we need to also look into the present value calculations. So let us look at what is the pension obligation over here. The pension obligation at the end of period 1 is that this person has earned 25. 25 of the 75 has been earned. So should we take the present value over here or take 25? What we do is we take the present value of 25. So the pension obligation at the end of period 1 would be 25 divided by 1.1 squared, which is equal to 20.66. I hope you are clear about why we are saying squared. We are talking about the pension obligation at the end of year 1. At the end of year 1, the employee has earned 25, which will be received here at the end of year 3. How much time is there between the end of year 1 and end of year 3? 2 years. So you discount 25 back 2 years at the discount rate of 10%. So your pension obligation at the end of year 1 is 20.66. What is the service cost? And here we come to the critical concept of service cost. How much has been earned? How much of the benefit has been earned because of service in the first period? That is also 20.66. That's how much has been earned. Now what about the second? Actually, before I go to the second period, so I'll summarize. During the first period, the pension obligation at the start of the period was 0. The pension obligation at the end of the period is 20.66. The service cost here is simply the change in the pension obligation, that is 20.66. And the interest expense is 0 because there was no liability at the start of the period. Now the second period will be a little more interesting. What is our starting obligation? It is 20.66. Can we quickly come up with the interest expense? The interest expense is simply going to be 10% into the initial liability. So the interest expense is going to be 2.066. And I'm picking very simple numbers so that you focus on the concept and not on the calculation over here. That's the interest expense. What about the service cost? I want you to quickly come up with that number before I give it to you. The service cost for the second year is 22.72. And how do we come up with this number? Again, this is based on the service performed or the work done in the second period. How much was earned? Of this 75, 25 was earned in the first period. And then 25 of this is earned in the second period. So to come up with this number, what did we do? We did 25 divided by 1.1 because there is just one period to go. That is the service cost for the second period. And then for the third period, the service cost would be 25. The interest cost would be calculated by taking the liability at the start of the period and then multiplying by the interest rate. And the pension obligation at the end of period 3 is simply 75. Right? So that illustrates two of the most important aspects or components of the service cost. In this case, to make our calculation straightforward and to understand the concept, we have not taken the third component, the remeasurements component, because we've not changed any assumptions along the way. Now, just to get some further intuition, what is the impact if assumptions do change? I gave you the most simple possible scenario where salaries are not going up, but that's obviously not realistic. So if we assume that the salary will go up at a certain rate, what is that going to do to our obligation? Obviously, the pension obligation will increase. I'm not going to do the numbers here. You will practice the numbers in the curriculum problem or the curriculum example on the next slide. But I just want to give the intuition. What about a change in the discount rate? Now here, the impact depends. Generally, it will increase, but there are two things going on. If you recall, for every period, we came up with an interest expense. Now, how did you come up with the interest expense? You looked at the liability at the start of the period, and then you multiplied by 12%. In our simple scenario here, where interest rate is going up, what's going to happen to the interest expense? The interest expense will go up. But remember the discounting that we do? When we take an obligation at the end and discount it back at a higher rate, what is it doing to the pension obligation? It is decreasing. So if you look at it one way, the interest expense is going up. If you look at it another way, the impact of a higher discount rate is actually beneficial. So later we'll talk about this, but right now I just want to give you this intuition. I also want to share one term. I don't think this is overly testable, but the method that we are using here is called the unit credit method, where each period of service gives rise to an additional unit of benefit at retirement. So rather than making this a continuous function, what we say is, okay, each period represents a unit, so you get credit when you complete the service for a particular period. As a general point here, if your period is very long, then a higher discount rate is going to have a beneficial effect. If your period is short, 2-3 years, then a higher discount rate will have a negative effect in terms of a higher expense. Now, I'm going to set you up with example 2, and one of the challenges with this particular example in the curriculum is there are so many calculations that you might get hung up in the calculation and not quite understand the concept. What I'm going to do is give you the main points, and then once you have the main points, then I want you to work through the calculation, and then we will make a separate video available that actually walks you through the calculation in detail in case you need that help. The scenario here is that, again, there is a company and we will just consider one employee. The current salary is 50,000, 5 years to retirement. Here we assume that compensation goes up at 4.75%, and we assume an interest rate or a discount rate of 6%. This company will be using IFRS, and based on the numbers given over the 5-year period, given this particular increase in salary, the final year's estimated salary is this much. This is simply compounding. In fact, most of the work done on this example is a combination of the concept I just talked about and time value calculations that you studied at level 1. In this example, you are asked to determine the pension obligation and the interest cost and the service cost under several scenarios. The first scenario is where the benefit is paid as a lump sum amount upon retirement. The plan will pay a lump sum pension equal to 1.5% of the employee's final salary for each year of service beyond the date of establishment. This is exactly like what I just did in my simple example. So we are saying that initially there is no obligation because the benefit that is paid over here is based on service starting at time 0. So initially the obligation is going to be 0. For the first period, the interest expense is going to be 0, and you will compute the service cost for the first period exactly the same way that we did on my example on the previous slide. And I would want you to work through the numbers. Then there is a second scenario where we do consider prior years of service. So we are saying that there is a benefit at the end which does consider the fact that there was service performed in earlier years. So how is this scenario 2 going to be different? It's going to be different because now there is going to be a pension obligation as we start. So there is going to be an interest expense in the first period. Then the third scenario basically is building on scenario 1 and saying that starting over here, when the employee retires, rather than a lump sum amount, the employee gets an annuity. Employee will get a certain fixed amount of payment which is calculated using a formula, but that payment is happening over 20 years. Does this make life difficult? Not really, because as you've studied at level 1, you have an annuity. You can simply take that annuity, come up with the present value over here, and then effectively the calculation is the same. And then with scenario 4, we combine what we've talked about so far, where we say that the employee will get the annuity. So again, we take the annuity and the present value of the annuity, and then we also say that the employee is getting credit for 10 years of prior service. So there will be a pension obligation at the start and there will be an interest expense at the start. Now what I would want you to do is pause the video and work through the example, and if you have any issues, then you can listen to our video that goes over these calculations in detail. Next we come to example 3, which is, I would say, very testable, because we will look at the effect of a change in assumptions. If we go back to scenario 3 from example 2, where we have 10 years of prior service and the employee receives benefit for 20 years of retirement, what is the effect on the year 1 closing pension obligation of a 20 basis point increase in the assumed discount rate? We had assumed a discount rate of 6%. If you go with a higher discount rate, what is the effect on the pension cost? We can actually do the calculations because now you know how to come up with the pension cost. When you do the calculations, what you will come up with is the following. The next question is, what is the effect on the year 1 closing pension obligation of 100 basis point increase if the assumed annual compensation rate increases from 4.75% to 5.75%, and assume this is independent of the first question. Obviously, if your salary is increasing at a higher rate, then the final compensation is higher, and our formula uses the final compensation. So what is the net impact going to be? The net impact is going to be that the pension obligation will be higher. And again, you have learned how to do this, so work through the numbers, and here again there is a video that explains all the working in case you cannot figure it out from the curriculum. Exhibit 3 from the curriculum gives a summary of the key pension assumptions, and we've talked about this several times. What does a higher discount rate do? It obviously lowers the obligation, because the obligation is based on a present value calculation, and by now you know that a higher discount rate means a lower present value. What about the impact on the periodic cost? Periodic pension costs will typically be lower because of lowering obligation. Notice this word typically. This means that it generally happens but doesn't always happen. The reason this typically happens is mostly the obligation is well out in the future. If the time frame is relatively long, then the impact of a higher discount rate is significant. And the point here is periodic pension cost will typically be lower because of lower opening obligation and lower service cost. So always remember, a higher discount rate means that the service cost is definitely lower, the interest cost is higher, and we are saying that generally this effect will dominate. What about higher rate of compensation increase? This will result in a higher obligation because the formula uses the final compensation. And then this will also increase the service cost. Service cost represents how much is earned in every period. Higher expected return on plan assets. This is a US GAAP concept where we consider an expected return on plan assets. There is no effect on the balance sheet number because in US GAAP as well as in IFRS, the fair value of the plan assets is used for balance sheet reporting. Under US GAAP, since we don't have this concept of an expected return, this concept is not applicable. Lower periodic pension expense under US GAAP. The actual expense shown in US GAAP is based on an expected return, and I'll show you an exhibit related to this. But for now, just remember the fact that if we use a higher expected return on the asset, that means that our overall expense is, our net expense is coming down. What about a few other assumptions? If we assume that the length of service is longer, what is that going to do? That will obviously increase the obligation. What if we assume a longer life expectancy? Then it will increase. It actually depends on exactly what we are promising, but if we are promising that we'll pay the employee for as long as he or she is alive, then a higher life expectancy will cause the obligation to go up.